Let's get real, early retirement isn't about luck, trust funds, or winning the lottery. It's about strategy, specifically using retirement accounts as a chessboard to outmaneuver the penalties, taxes, and the system designed to keep you working until 65. Enter the Roth IRA Ladder, a completely legal loophole for tapping into your retirement savings decades early, tax-free. But here's the kicker: banks, financial advisors, and even your employer's 401k provider won't teach you this. Why? Because it threatens their profits. Let's break down exactly how this works, why it's a game changer, and how you can pull it off even if you're starting late. The Roth IRA Ladder, your ticket to early retirement, without the penalties. Picture this: you are 42 years old, have saved $400,000 in your 401k, and are ready to leave the grind of corporate America. There's just one catch: you can't touch that money until 59.5 without a 10% early withdrawal penalty. That's like having a vault of cash you can't open. It's called the Roth IRA Ladder. The Roth IRA Ladder solves by allowing you to convert chunks of pre-tax retirement savings, say, a 401k or traditional IRA, into a Roth IRA over time. Those converted funds and their growth, after 5 years, can be taken out tax-free and penalty-free. Here's where the step-by-step magic happens. First, year 1, convert $25,000 from your 401k into a Roth IRA. Second, year 2, do it again for another $25,000. Third, year 6, withdraw the first $25,000, and its growth, tax-free. By staggering conversions, you create a sort of ladder of accessible cash. Each rung, conversion, has its own 5-year waiting period, after which it's yours to spend. This works because Roth IRAs allow tax-free withdrawals in retirement, but also let you pull out the converted contributions penalty-free after 5 years. The key is patience. If you retire at 50, you'll need enough converted funds to cover expenses until 59.5, when traditional retirement accounts unlock. But wait, why isn't everybody doing this? Simple: most people don't know it exists. Banks and financial institutions make money off your ignorance. They'd rather sell you high-fee managed accounts or annuities than teach you a strategy that costs them nothing. Why banks hate the Roth IRA Ladder? What they are not telling you. Let's get real. Banks and brokerages make money by keeping you trapped in their ecosystem. Think 401k management fees, 1 to 2% annually, mutual fund expense ratios, and commissions on expert advice. The Roth IRA Ladder bypasses this entirely. Rather than parking your cash in their high-fee accounts, you move it into a Roth IRA more often than not, lower fees and more flexibility, like investing in low-cost index funds or even real estate crowdfunding. Here's the brutal truth. They lose fee income. A $500,000 401k generates $5,000 to $10,000 per year in fees for them. A Roth IRA with Vanguard or Fidelity? Maybe $50 per year. They can't sell you junk. Banks push products like annuities because they earn massive commissions. A Roth Ladder means you don't need their overpriced, guaranteed income schemes. You are finally debt-free. Banks make money off mortgages, car loans, and credit card debt. Retire early on a Roth Ladder, and you will never have to borrow. This isn't conspiracy theory, it is just plain capitalism. The system is simply not designed to help you get away. It is designed to keep you paying for it. That Roth IRA Ladder is your way out. How to build a Roth IRA Ladder, a no BS guide. Ready to get started? Here's how to implement this strategy without tripping over IRS rules or tax traps. Step 1, start early, but late starters, listen up. If you are in your 20s or 30s, you have time to convert small amounts yearly to minimize taxes and maximize growth. But at 52, one can build a ladder to bridge the gap between early retirement and 59.5. Key thing is, calculate your annual spending needs. For example, need $40,000 per year in retirement, then convert $40,000 annually at age 50. By 55, you'll have 5 conversions, totaling $200,000. At 55, the first conversion, year 50's $40,000, is penalty-free. Pro tip: utilize a Roth conversion calculator because most do simulate taxes. If you make $80,000 per year, for instance, converting $20,000 per year may keep you in the 12% tax bracket and avoid jumping you up to 22%. Step 2. Convert strategically, timing is everything. Best time to convert? Low income years. Suppose you retire at 45 and freelance part-time. Your income drops to $30,000. You could convert $40,000 that year a lot cheaper in taxes than it would have been in those peak earning years. Watch out for state taxes. 9 states, most notably California and Minnesota, tax Roth conversions. If you live in Vermont, converting $50,000 could mean a $2,500 state tax bill. Research your state's rules or consider moving to Florida or Texas, no state income tax, before converting. Step 3. Pair with a taxable brokerage account. The 5-year waiting period is a big hurdle. Solution: pay for the gap with a taxable brokerage account. For example, one could consider the following. Years 1 to 5. Withdraw $40,000 per year from your brokerage and pay capital gains taxes, often 0 to 15% versus income taxes. Year 6 plus. Tap your Roth IRA conversions tax-free. This hybrid approach keeps your retirement savings intact and avoids debt. Step 4. Track the 5-year rule like your life depends on it. Every Roth conversion has its own 5-year clock. Miss the deadline, and you'll pay a 10% penalty on earnings. Use a spreadsheet or app, like Quicken, to track each conversion's date and amount. Example: convert $30,000 on January 1st, 2024. Available penalty-free on January 1st, 2029. 5 deadly mistakes that can blow up your early retirement. Mistake number 1: overconverting and jumping tax brackets. Converting $100,000 in 1 year may bump you from the 24% to 32% bracket. Instead, spread conversions over several years. Fix: IRS tax tables are your friend for staying in your bracket. You make $100,000, you convert up to $15,000 to stay in 24%. Mistake number 2: ignoring healthcare costs. Early retirees often forget about health insurance premiums, easily $1,200 per month for a family. If you're under 65, Medicare isn't an option. Fix: budget for ACA plans, subsidized if income is low, or work part-time at Starbucks for health benefits. Yes, people do this. Mistake number 3: underestimating inflation. The 4% rule assumes 3% inflation. But when inflation reaches 6%, your $50,000 yearly budget inflates to $80,000 after 10 years. Fix: add a 2 to 3% buffer to the withdrawal rate. If you think you need $50,000, you plan on $53,000. Mistake number 4: forgetting state taxes. As noted earlier, states such as Oregon tax Roth conversions. Fix: try converting $100,000 in Oregon, and that is a $9,900 tax bill. Move to Nevada, no income tax, for a year before converting. Mistake number 5: not having a contingency. Market crashes happen. If your Roth IRA drops 30% in year 3, can you still cover expenses? Of course you can't, because you didn't save cash. Fix: keep 2 to 3 years of cash in a high-yield savings account. The Roth IRA ladder isn't about accessing money early, it's about designing a life you don't need to escape from. It is the antithesis of these traditional retirement plans that always regiment you into this very rigid timeline. Pair that with geographic arbitrage. Retire in Portugal, where a couple can live in comfort for $2,500 per month. Side hustles: make an extra $1,000 per month blogging about your early retirement. HSAs: pay for medical expenses with tax-free dollars using a health savings account. But the real magic is in the math. The compound growth works harder in a Roth IRA. For example, if you convert $30,000 at age 40 and it grows to $150,000 at 60, assuming 7% returns, all completely tax-free. In a traditional IRA, you'd be paying taxes on every dollar that's in it. Concluding thoughts: how to make this work for you. 1. Start small. Convert $5,000 this year. See how taxes impact you. 2. Consult a fiduciary advisor. They're legally bound to act in your best interest, not because some commission has come their way. 3. Test drive early retirement. Take a 3-month sabbatical using your ladder. Adjust your plan as needed. Banks might hate this, but your future self hiking the Alps at 52 will call it genius.